Welcome to the road to financial independence. I'm president of CPS Investment Advisors, Mike Riskin, and I'm joined by my partner, as always, CEO of CPS, Peter Galacco. Hey, Pete.
Hey, Mike. How you doing?
Terrific. How about yourself?
I'm doing great.
Well, appreciate everyone tuning in for this special episode of the road to financial independence.
Yeah.
Today, we're going to get back to some of the basics, fundamental investing, and there's a lot of talk and noise out there in the investment world, and so Pete, just kind of before we get into the fun, so to speak, kind of set the tone here of where we're coming from and what you're seeing out there right now.
Sure. What's going on right now in the market is a lot of your great American stocks are not performing very well. And one of the reasons for that is we've got a tech sector, actually anything that touches AI,
That's right.
everybody wants to own. And, you know, I get a lot of questions, what about this company? They've been in business 2 years and they're 80 times earnings. And, what about this company? What about this company? And a lot of times I've got to ground myself and go back and take a look at what the best investor ever says about what's going on right now. And, if you take some of his tips and quotes and learn from them, you're going to do very well, because time and time again, we see this kind of action in the markets. And it always comes back to what he says.
It does.
When all the dust settles, you go, good old Warren said that, and we didn't follow his advice. But he was a very smart man. He took all the shiny, glittery stuff out of the market and went back to the basics, knew what he was doing and why he was doing it, and did better than anybody out there.
That's right. That's right.
So when I question what's going on, I always go back to see what he said. I've been in the business for a long time, and some of the people listening won't remember 2008. But 2008 was when the financial sector fell apart, real estate fell apart, and the only thing you heard on TV is, "This has never happened."
Right.
This is new. But they forgot about the late 80s when the real estate fell apart and the financial sector fell apart, and all these banks had to. Give it 20 years and we forget everything. It's amazing.
There typically is a playbook for these types of scenarios, and the way the markets respond and react, and it's very emotional at times as well.
It is, and you can go back through time, and during these times, you can definitely see how people react. I remember back in 1997, 98, 99, when we had the tech run up in the markets. And everything I heard during that time was .com.
Right.
If you weren't buying .com, you're going to miss out on everything. That stodgy old investment doesn't work. The new investment is here. Everybody needs to buy .com. 2000 hit, and nobody wanted to own .com.
Or there wasn't much left that you did own.
That's right. So, and that was a very painful experience for a lot of people back then. But, I'm looking at what's going on right now, and I'm hearing AI.
Right.
And if you're not buying AI, you're not going to perform. That kind of scares me a little bit.
Yeah. Well, when we went to go buy when you go buy a car or in some non-financial transaction world, and everyone's talking about those things, that's a worrisome sign.
Yeah. Well, back before the Great Depression, Mr. Kennedy, not John F. Kennedy's father, he was the one who started the SEC. And the reason why he started the SEC was he was getting his shoe shined before the recession, and the shoe shine boy was giving him stock tips.
Exactly.
And when he got up and left, he said to himself, "We got a big problem. If the shoe shine boy is giving me stock tips, this thing's going to fall apart." Right. He sold all his investments, and the entire economy fell apart. So he was named a genius back then because of this. But when people are saying AI, and they're not even investing their money, but you got to buy this stuff, you want to be careful. That means there's a lot of risk in your portfolio. There's a lot of risk out there, and you don't need to take a lot of risk to buy AI. Buy the stuff that's going to be there for the next 100 years. That's going to own AI when it's all said and done, not the ones that are running the prices up dramatically.
That's right. No, that's some great advice, and certainly our motto of "steady as you grow," speaks to that, and the true and tested stocks and companies that are actually making money have solid found financial statements, cash flow, and those types of things. So let's dive into some of the fun. I got some Warren Buffett quotes here, and get your take on what's behind them, so to speak. The first one: stock market's a wonderfully efficient mechanism for transferring wealth from the impatient to the patient.
That is an incredible quote. And what he meant by that was during this time right now, people are very impatient. They got to buy this. They got to buy this.
Especially nowadays with everyone's got the computer
and we have to have it. We have to have it. It's those that sit back and say, you know what? My portfolio isn't performing very well, but I'm still getting a 3% dividend. These stocks are still making a lot of money. Maybe I buy a little bit more here and be a little bit patient. And in a year, things seem to turn around a lot.
Long-term investing.
Long-term investing. And usually it's not long-term to see your investments do well. I mean, you just have to wait a little while. Things always turn around. So be the patient one. We always say be the tortoise and win the race. Hit doubles and singles. Yep. Let the other people try to hit home runs and just take their money when they start selling their stocks for cheap.
The home runs turn into strikeouts eventually.
Right. That's right.
Yep. Another great one along the same lines there. Be fearful when the market gets greedy, and be greedy when the markets get fearful.
Yep.
So, I love that one.
So I want to bring back the example of 1999, 98, 97, when we had the tech bubble growing. People were greedy. They were actually going and refinancing their houses to buy these tech companies because they were growing so fast. We had, in the CPA world during that time, we had very few CPAs coming out of college with a CPA certificate because they could get more money going to finance through the .coms. Well, that all fell apart. So when people are being greedy and they want, sell those horrible investments to them and hang on. Now you're going to be able to buy things on sale when everything falls apart on them. Because what investors normally do is they drive the market up way too far.
That's right.
And then when it goes down, they drive it way too far down. Just hang on. It'll fix itself.
That's right. Yep. Got to seize those opportunities.
That's right.
And speaking of those opportunities, I love this one. We don't have to be smarter than the rest. We have to be more disciplined than the rest. That really, really speaks to how we roll.
That's correct. Discipline meaning you have to have a goal, a path where you want to end up. And you need to get on that path, and you need to stay on that path regardless of what shiny object up there takes your attention away. Because there's always something to invest your money in that's not going to do well for you. But there's a lot of stuff that has been tried and true that all you got to do is buy it, hold it, and close your eyes, and you're going to be very, very happy. The things that you got to watch on a daily basis is very stressful. And a lot of people can't make money on those because the market moves too quick.
Right.
You don't know which way to go. So buy something really good and hold on to it. It's going to pay you very well in the long run.
Yeah, and I think it goes back to having a foundation and a discipline like we discussed, because, pretty much anyone can make money when the markets are going up.
When the markets, absolutely.
When the markets are going down, to have a strategy, have a foundation that says, no, we're not going to sell the stock because of this, or we're going to sell because of this. But if you don't have a strategy and you're just chasing the bright, shiny object, and that stock is plummeting on the way down, there's no rhyme or reason other than just the whim of momentum of the stock market. I mean, that's when they talk about the casino of Wall Street. I mean, that's the gambling of the Wall Street versus
you're absolutely right.
Versus value investing and truly investing.
You're absolutely correct. And Warren had a great quote on that. He said, "Only when the tide goes out do you discover who's been swimming naked." And what that means is when the markets are going up, people have a tendency to put a lot of risk in there. We want to buy what's going up. Well, when the market goes down, the tide goes out, and you got great stocks that are trading at 15, 18 times earnings instead of these stocks trading at 80 times earnings. You're going to see who's not wearing a swimsuit.
That's right.
Yep.
I don't want to be there for that.
No, me either. There's some things you can't unsee.
That's right. That's right. Another one of my favorites, and I think we might even have this in our office. Price is what you pay, and value is what you get.
Right.
And I think we kind of live by that in terms of the service of delivery of service that we try to give to our clients too. But talk about it in terms of how it relates to stocks.
So when you're looking to invest your hard-earned dollar, you want to buy value. And value doesn't always equate to the price of the stock. So if you got a great company and it's trading at an 18 PE, 18 times earnings, but their revenue is expected to increase over the next few years much more than that, you may figure I can spend a little bit more money on that, get that in my portfolio, because long term, I'm going to make a lot of money doing that.
Right.
It's where people on the way up, they follow the stock way up and they buy it at the peak at a horrible price earnings ratio. And then all of a sudden, there it goes down. So, you want to buy value. You don't want to just look at price.
Right. And I think one of the things that gets a lot of investors is when we talk about price, is the thing, it's $2 a share.
Yep.
And so, it only has a little way to get to 3
That's
versus that 100, Apple's or I shouldn't, name names, but this company is at $110 a share. That's too expensive. Well, that's a real company making real money. That's
right.
going to increase their earnings by 10% a year. That 110 is going to turn into 1,000 a lot quicker than that. That 2 is going to go down to like 50 cents more likely, because there's nothing behind that, even that $2 a share. So people get so caught up on the price versus what they're actually buying.
Yeah, it's not. It never should go to the price. It goes to the value. It goes to the value of the company. And you're absolutely right. You got companies out there that are selling, at deep discounts.
Right.
They might be a reason for that.
Right. And a deep discount might be $400 a share.
That's correct. That's correct. So it's what the company does. I am a huge proponent of durable products. I want, regardless of the economy you're in, I want my companies to continue to grow their revenue, grow their dividends, pay me more, regardless if we're going to recession or anything else. So when you look at companies like that, they're going to be your biggest and best companies out there. But they may not be in the hottest industry that is screaming right now.
That's right. That's right.
But we all know what goes up fast comes down fast.
That's right. Gravity.
Yep.
Man, there's nothing more fun than those dividend paying stocks, and a year goes by and all of a sudden you got a 7, 12, 15% pay raise from that dividend.
Absolutely.
I love that.
It's nice now where, there's some sectors that great companies are beaten up. You can get them on sale now and keep investing in them, and whenever they grow, all of a sudden you got more shares growing.
That's right.
More shares means more dividends, more return, more growth. And that's how people build wealth. It's not buying the thing that's growing the fastest. It's looking for stuff that has great value, knowing that in 5, 10 years, you're going to do very well in that stock.
Yeah, exactly. Well, Pete, as always, the time flies by. We could probably spend another hour having fun in this manner, and maybe we'll do a follow-up. This was fun, kind of a short, but also not just the quotes and whatnot, really tying it into the philosophy of investing, value investing, and kind of how we think.
It's too easy to forget what the fundamentals are.
Right.
When there's a lot of noise out there.
There's a lot of noise, yeah.
And you got to be patient enough and look at that as noise. Yeah, maybe we might miss the AI by a year. Well, if it's going to be that great, you're going to have the next 50 years to buy into it.
That's right.
But if it's not that great, you're going to lose money with a lot of
spend the next 15 years trying to make it.
That's correct. That's correct. So you don't need to put a lot of risk in your portfolio to get good, decent long-term returns. But if you do put a lot of risk, you're going to have a lot of volatility.
And tune into our YouTube channel or anywhere else where you get your podcast for other additional educational content. We've got a lot of things rolling out here in 2025. Thanks again for watching. And if you'd like to contact us, feel free at info@cpsinvest.com, as well as 863-688-1725. And look forward to doing this again soon. Thanks again. Bye.